Welcome to the EHE Fast Growth Podcast. I'm Simon Landy, the CMO here at EHE Ventures Studio. This series is where ambitious founders and forward-thinking investors come to scale big ideas the Venture Studio way. Whether you're building, backing, or just exploring what startup success looks like, you're in the right place. Let's get started. Hi, and welcome back to Fast Growth the Venture Studio way. Today, we're digging into something that we don't think is visible enough in early stage investing, and that's co-investing, where two or more investors collaboratively invest in the same company or opportunity. When it's done right, co-investing brings more capital, more expertise, and frankly, more firepower to startups. But it can also go wrong, and when it does, it can slow everything down. So I'm pleased to say that I'm joined by two experts in this field. Firstly, David Walters, Investment Director at River Capital, one of the UK's most active early stage investors. Hi, David.
Hi, Simon. Thank you for having me.
Pleasure. And secondly, Jack Worne, our Head of Investor Relations at EHE Ventures Studio. Hi, Jack.
Hi there. Good to be here.
Good to have you both. So obviously we've worked together, EHE and River, on live deals, but more on that later. But we're here to talk about how co-investing actually works, who does what, where the real friction is, and whether the UK ecosystem, especially here in the North, is even set up to make it work. So before we do that, David, it would just be good for you to give us a bit of background or a snapshot of River Capital and your role there.
Sure. Thanks, Simon. So, we've been investing across the North for over 30 years. Probably a lot of people will know us as MSIF, the Merseyside Special Investment Fund. And as I say, we were set up about 30 years ago to try and stimulate the city region, the Liverpool City region in particular, and the sort of broader northern economy. And we think we've been a key part of that kind of regeneration. We've got roughly £100 million under management across a number of different funds. So we have a private equity fund, we have a venture capital fund, which is where I work, and we have a series of debt products as well. I'm an investment director. My background is I used to be a CTO, Chief Information Officer. I've run a number of different AI funds as well. And we look to back early stage, high growth companies out of our River Capital EIS AI fund. So we launched the fund in late 22, just before the explosion of Gen AI. And we looked
perfect timing then.
Perfect timing. Well, it was certainly a double-edged sword in terms of everybody thinking that AI was going to take our jobs.
True.
Yeah, I mean, we're looking to back businesses that have got a lot of data. They're on a data science journey, machine learning journey, an AI journey. Typical check sizes between anywhere as low as 250K up to a couple of million. And we always like to co-invest. In fact, every one of the 8 deals that we've done over the last 2 years has been alongside a range of different co-investors. So that's River Capital. That's me, and looking forward to the podcast.
Brilliant. So you are expertly placed to help us with this. So first question to you then, before I go on to Jack. So when you hear the term co-investment, or when you use the term co-investment at the early stage, what does that mean to you? And how does that all work?
Yeah, I mean, I think all companies, particularly in the kind of early stage part of their journey, will likely need more capital. Whether that's because they're coming under cash pressure or they're doing well and they want to go a bit faster. So for us, at least, having a number of institutional investors around the table is a really good thing. Particularly if, as I say, the round needs to extend a little bit, there's a desire for a follow round. Every one of our fund AI deals has a co-investor around the table for that very reason. And we always have a strong alignment on terms. And I think kind of the theme for me running through this chat is about making sure that kind of strong alignment's in place between the co-investors. The kind of term lead, I think, is quite an important one for us to sort of get stuck into on this. My view is that once the investment has happened, that kind of lead investment concept kind of falls away a little bit, and we're all there really to kind of support the companies. But I think a kind of lead investor is really doing two things. So first and foremost, kind of setting the terms, and they're pretty normally kind of standard BVCA terms for the company, which most early stage investors kind of reflect and replicate. And I think the other thing is genuinely kind of agreeing the valuation with the company as well. So those are the kind of big kind of handfuls for the lead investor. But I think the biggest check doesn't always mean the deal has been originated from the lead. So we've found some cracking businesses just because of our networks where we haven't led the deal, but we've gone out and we found somebody to lead it. So I think that's a kind of important point. It's a relatively small community of investment directors out there, particularly across the north. So it's normal for us all to sort of be chatting about deals and to be introducing kind of new deal flow to each other. But again, for us, that kind of co-investment strategy is super important. We never wish to underfund the business, no matter how much we like it. And actually, should we find a cracking company, but we're unable to find a co-investor, that will very definitely kind of slow the whole process down.
All right. Yeah. And then Jack, I suppose there's a lot of good stuff there. And obviously David and River Capital have been doing this a lot longer than EHE have been doing it. So what's your sort of take on this, the sort of co-investment space and where we sit in that?
Yeah, I mean, there's an awful lot of opportunities out there, and all at different stages of their kind of funding process. There's a lot of siloed conversations happening with different investors and founders, and it's almost when a lead steps forward to set terms, and ultimately they'll have the highest level of conviction to step in as a lead investor. Soon after that, it suddenly starts to become a bit more tangible for co-investors. They kind of have visibility on a valuation, on terms, and understanding kind of more about what the round will go to in terms of a cap and timeframes, etc. So it's really important once the leaders step forward that it enables like co-investors to have their own confidence in joining that process and taking it a bit more serious. And that's one point I'd say. Just overall, the lead investor stepping forward, it brings a lot of confidence to other investors to join the round.
And I guess the lead investor is obviously sounds like it's very pivotal to any of this kind of investment. So how do you manage those relationships between investors when you've got a lead and then you're considered what are you considered if you're not the lead? A follower? How does that work?
Yes, follower, co-investor. It's almost, you hear about the progression within these siloed investor conversations, either by chatting with the friendly funds that you work alongside, like ourselves and River, or through the founder. The founder will give you an update. If you're in conversation with them, they'll say, oh, we've made some progress over here. Here's the name. And that suddenly kind of prompts a broader conversation where each investor has more information to go off and enable them to kind of progress on their side a bit quicker.
But from your point of view, David, I guess you've sat in both chairs, have you? You've sat in as a lead investor and as a co-investor. What are the differences you've seen in those two roles?
Yeah, look, I think the kind of concept of lead investor falls away post-investment, or at least it should. I think there's a very definite kind of reason for that kind of lead investor as the fundraising happens for the management team, again, setting the valuation, setting some of those terms. But, River Capital and EHE invested in a company over in Salford, and we just basically developed a very strong relationship. We're an extension of the management team. I think if at any point the kind of lead investor is starting to flex their muscles a little bit, or is it's becoming a problem, then something's gone wrong. Strong collaboration is kind of super important. We're all there to basically help to grow these companies, and we'll all have different superpowers. We'll all have different kind of experiences. So I think, the kind of textbook world of a VC has this kind of concept of a lead investor. I think once the investment's done, we're all there to just try and support the team in any way, kind of shape or form that we can. And I think that just making sure that whether you're a lead investor or not, making sure that you kind of understand a little bit about the culture, the value add that your partner can bring, is super crucial. Because the last thing you want to do is kind of go into an investment and find that you're kind of working alongside somebody who's kind of taking that lead investment role a little bit too seriously, almost.
Seriously, yeah.
But for me, once the investment's happened, we're all an extension of the management team. We're all there to help. The roles will settle down a little bit. And if you take one of the companies that we have co-invested alongside EHE in, EHE have picked up some much more of the kind of financial role and the financial support than us, and we've been focusing into the go-to-market stuff.
And that might vary depending upon another investment. It might flex slightly differently again.
Yeah, exactly.
Yeah. So do you think, both of you really, but I'll come to you first, Jack, in terms of genuine collaboration in this space between the VCs, particularly in the North, do you feel like there's enough collaboration between VCs so that this co-investment can sit comfortably across businesses?
Yeah, there is a lot of collaboration, especially in the early stage deals, pre-seed and seed, because it's the highest risk, and ultimately investors want to kind of share that risk and maximize the runway in order to give them enough time to kind of deliver on the plan. So I'd definitely say it's collaboration first rather than competitive. I think as you get to later stage VC, Series A and beyond, where there's really strong metrics driving the opportunities and the strength of the companies, from what I'm seeing, it's definitely a bit more competitive to kind of be that investor that secures that and lands that deal, as opposed to just broadly collaborating on higher risk opportunities.
Yeah, I think that kind of competitive word's quite important, actually. I've seen a very definite shift over the last 18 months away from funds almost in some instances competing against each other to collaborating much more. I think it's a very definite thing over the last 18 months. And I think probably or possibly that's because the EIS market's been a bit up and down over the last 18 months. And so, there hasn't necessarily, there's less firepower for some of the EIS funds in particular. And so that kind of, they spot a great business. Perhaps EIS raising has not been as strong as their forecasts or budgets. And so, there's a byproduct of that, which is people want to co-invest alongside each other, again, not to underfund the company. I think the SEIS funds as well, in particular, over the last 12 months or so, have been a lot more collaborative. And clearly, there's a kind of limit of £250,000 SEIS allocation for a company. But, potentially the round's 500,000 or $1 million. So, there's unless an SEIS fund has their own EIS fund, they need to go and find a co-investor. So I think there's been a shift away from competition, which was possibly the case. Maybe I'm being a little bit unkind, but was possibly the case about 18 months ago, to far more collaboration. I mean, we are now collaborating with you guys with lots of different northern funds, all of the SCIS funds, which aren't necessarily in the north, and increasingly some of the London-based funds as well. Some funds, of course, can't collaborate because their check size needs to be too big, or the turnover figure of the company is perhaps a little low for their fund rules. But yeah, very definite shift to collaboration, I'd say.
Even when there's kind of deals on the go and things are trying to be structured, it just naturally requires collaboration just to align timeframes and ensure that the whole process doesn't drag, really. So it naturally just requires that communication and engagement between the investors. One, just to kind of check we're on the same page and seeing the same type of opportunity, because these stage companies, they can kind of grow in many different directions, and it's always good to just align with the potential co-investor that you're seeing the same kind of opportunity and same direction that it's going to grow in. But also just making sure that, if there is a breakdown of communication, that, you can just pick up the phone to a co-investor and say, how do we kind of speed these things up? Because the quicker the deal gets over the line, the quicker the founders can be back growing the business and not distracted on fundraising.
Yeah, exactly. Yeah, the last thing you want is deal fever.
Yeah. So, David, you're probably the best place to answer this. Is how did our co-funding come about? I mean, I know we've mentioned as a business, one in particular that we've co-funded or co-invested in together. How's that come about? Did we both look at the opportunity separately and then come together, or was it your opportunity and that you then spoke to it? How did that come about?
Yeah, so I met Neil Vos at Climb 24, and sort of, we're both investing in similar sorts of companies, artificial intelligence companies, or tech-enabled companies. We've got a big data angle, and I just wanted to add kind of you guys to my kind of network of people who I might go and talk to should I see a business that needs a co-investor. So the particular company that we co-invested in, I've been kind of watching it for a couple of years. I felt that it was kind of smack bang in the middle of the space for Fund AI, which is our EIS fund, and struggle a little bit to find a co-investor. And you might say, well, is that because it's not investable or not? But I kind of reflect back on. So we last year we had 6 exits, which for this not from the EIS fund, but from our kind of wider fund manager. One of them was a business who had a similar kind of fundraising co-investment challenge with. And we sold it after 2.5 years. We made pre-tax returns, 60% IRR. And on the exit dinner, at the end of the exit dinner, where we took the kind of management team out just to kind of celebrate, the CEO came up to me and said, "David, you guys believed in us when nobody else did." And at the heart of co-investing for me, it's about finding a co-investment partner who equally believes in the business. They can see something that perhaps not everybody else saw. And so when I introduced this company to EHE, I kind of got a sense that, you guys equally saw the opportunity, your expertise in AI and in venture building, just help you to kind of understand the opportunity there. So that's a very long-winded way of saying I introduced this company to you guys. You did your own diligence on it. I helped to support a little bit with some of the kind of diligence that we'd done, and I think we both felt good valuation first and foremost, great opportunity to support it, great opportunity,
great founder, isn't it? Great founder.
Very strong ESG angles. A real opportunity to build out the company much more commercially.
Yeah, no, brilliant. No, it's just so important that founders out there do understand, what we're thinking when we're having these conversations, because it's really important that they look at co-investing as an opportunity or as a way of, getting lots of support rather than it, being anything like that. Definitely.
Yeah.
Thank you.
Even in kind of the first 6 deployments that we made earlier this year, the feedback amongst the co-investors on those deals has been really positive, because we're kind of coming at it from a technical angle, like lifting the bonnet on the product, looking at the tech roadmap, and really getting in the weeds of the tech strategy. And from another investor perspective that might be a domain expert that is in a certain sector, it's really complementary, because we're kind of filling their blind spots, and likewise they're filling our blind spots in terms of whether the go-to-market is achievable, or whether there's expertise needed or subject matter experts needed to be brought in to kind of help the business grow operationally. And together we just kind of cover those 2 big blind spots that ultimately they're 2 key pillars at this stage of tech investing, tech and the product and getting under the bonnet of that, but also the go-to-market. And in this deal in particular, that's worked the same way between us and River.
Yeah. And I think also just helping these management teams to run a business. Lots of them are tech founders, or the company that we're talking about is the Manchester Uni spin out. These guys haven't run a business before, and so we all sit on different boards. We've perhaps been operationally much more experienced than some of the founding teams. And what I've noticed on this particular deal is, we River and EHE have come together to help out on cash flow management, on cost control, on building out the KPIs, on GTM. And more than anything, I think that value add is just as important, if not more important, than some of the kind of tech stuff that we also support on.
Yeah, and you talked about these companies building out a strong team of expertise inside the business in each kind of area, but it works the same way for having a team of investors that are complementary to the business that can cover different specialisms as well.
Yeah.
Yeah, no, good. Yeah, good. Thanks very much. And then I guess this is quite straightforward, but how do you make sure you keep your decision making independent from each other and not necessarily following on, but trusting in your own decision, but you're still reflecting that in other people's decisions as well? Because obviously we collaborate, therefore there's some trust between us as well. So how do you balance that?
I mean, going back to kind of having that lead investor in the first place, or other investors that are progressing at pace, it allows us as an investor to kind of progress with a bit more conviction, because we know things are shaping and we know there's a timeline being developed. I wouldn't say necessarily you'd cut corners on any diligence, knowing that there's a lead investor there, but it just give you more confidence to kind of move at a bigger tempo. Ultimately, well, both investors have their own thesis and their own IC, so that governance in itself prevents kind of any people cutting corners or leveraging the other person's kind of diligence. They're very, very impartial, but it's just, I think, having those investors progressing at the same time, it just allows both sides to just move with a bit more conviction and pace.
Yeah, I think that's right. And we've all got our superpowers in diligence. I think probably though, that kind of independence of financial diligence is, that's, for me at least, that's the most important thing. Sometimes a co-investor will share delicately some of their financial diligence. I'll always kind of just do my own from start to finish, or we will. At these early stage kind of investments, it's not typical necessarily for kind of external financial diligence. And so, I'll always make sure I've got a sensitized cash forecast. We must always have a kind of 18-month cash runway on a kind of downside scenario. So, and not all funds will have exactly the same rules and regulations that they apply to an investment. So I think from a financial DD perspective, it would be unusual for anyone to rely on anybody else's. But there are other aspects, like, you know, you guys got some great superpowers in tech DD. We've got some great superpowers in AI operational stuff, plus go-to-market stuff. And so it all just builds up. And as Jack says, speeds up that whole kind of process to ultimately get to a final decision.
Yeah. Yeah. And in terms, I know we've covered we've started to talk about the ecosystem that we're in. And obviously, David, you mentioned the fact that your ecosystem is national now, and that you're co-funding with VCs across the country. What more could we do in our region or in the north to do more co-funding or to provide more opportunity for founders in this space? Is there anything you think we could do more of as a cohort?
Yeah, I think it's just evolving by osmosis a little bit at the moment. I think that, as I said before, there's a genuine, I think, move towards more co-investment, and I think kind of podcasts like this are really useful to just sort of keep that agenda very high. I mean, there's a very definite gap for funding for businesses that are sub £1 million revenue, in my view, in my humble opinion. And that kind of shrinks down the cohort quite a lot. So, that will rule out, some other funds for that kind of co-investment stage. And at the other end of the spectrum, you've got you've got angels and you've got the incubators, and you've got grants, I suppose. So there's still very definitely a sort of gap for that kind of pre-£1 million turnover investment model. I think dragging up some of the London-based earlier stage funds into that cohort is going to be important. We've done a little bit of it now, but I think podcasts like this, if we can kind of get the message out about the great stuff that's happening in the north, typically lower valuations, finding ways to get those earlier stage London-based funds to be co-investing with people like us. I think we need to find ways to do that.
Yeah, because you mentioned the SEIS funds that are mainly London-based, which I can immediately see would be a really, really good co-investment opportunity. Definitely.
Yeah, and again, that is starting to happen. So I get calls from some of those guys, and they're interested to kind of share deal flow back and forth. So it is starting to happen, but we just need to keep emphasizing it and keep the message out there.
Yeah, keep working. What about you, Jack, from your point of view?
There's definitely a lot more co-investing happening up north. There's a lot more liquidity now. There's a lot of funds that are sector specific or geography specific, which can almost limit the amount of co-investing that can take place, because you've got you take AI, for example. AI is touching on a lot of sectors now. So when you've got an AI opportunity, you've almost got to locate those appropriate investors that it fits the thesis or geography for them, as opposed to just broadly having a tech opportunity or a B2B SaaS opportunity. There's this like extra AI element that almost means it's kind of on the fringes of a lot of funds thesis out there in geographies. I'd say, the easy bit is once there's investors at the table, then kind of topping up and filling around. I'd say that's kind of, if you got to that point, you're in a strong place to kind of close out around. It's almost getting to that first cornerstone capital for the founder. That's the hardest bit of any founder's journey. And how can we kind of improve that? How can we make it more accessible to be the lead investor at that stage? Because ultimately we're investing at the highest risk stage of founders' journeys. So if there's ways to almost make de-risk, and I know the schemes themselves, the SEIS and the EIS schemes help with that. They give kind of downside protection, etc. But if there were ways of kind of enabling someone to lead an investment more confidently I think that would open the door to a lot more co-investment and a lot more deals closing out and filling up.
Okay,
And I think,
cool.
I think just more generally, the EIS market more generally needs more exits.
Yeah.
And I think the more exits, the more investment, the more deals that get done. That's
100% agree. 100% agree.
Front and center, and we think very carefully. Obviously, we think very carefully about the investments that we're making and make sure that it's not spray and pray. There's a really strong opportunity to exit these companies.
Yeah. No, and we hear that lots and lots, because the more that happens, the more visibility there is, the more confidence there is, the more money there'll be, invested. Makes perfect sense.
Yeah.
That's it. And I don't know if either of you have got anything else that you wanted to talk about or anything else you wanted to mention. But I just wanted to give you that opportunity. I don't know if there's anything either of you. There's one question I had, but I'll ask it at the end. Have either of you got anything else you want to cover off or mention?
No, I think it's a great. I think it's a great subject matter, and the more people can co-invest, the better. Really, just give our companies the firepower they need to go on those exit journeys.
Yeah, and I'd just reiterate a word that I've probably said 2 or 3 times on this call, which is kind of conviction, investor conviction. And David mentioning the exits. If there's more exits, it will just increase the amount of investor conviction out there. And if there are ways to increase conviction, ultimately sharing risk with co-investors, that will enable a lot more deals to take place. Yeah.
So the question I've got, which it's only come about, and it might be my naivety, but in relation to a previous pod we did where we talked about grant funding, and quite often grant funding is provided subject to getting private capital as well. Do you consider that co-investing, or would you call that something different?
I did think about it as co-investing for a little bit. So my sort of batting order of co-investors. Top of the pile is institutional investors who have the ability to follow. Second is angels who may or may not follow. And then third, by some way, is grant funding.
Right.
And just to go right back to the start of the loop, the reason why we look for co-investors is every company's going to need more money at some point. The likely place that's going to come from is your institutional investors on the cap table. It probably won't come from grant funding. For what it's worth, that's my view.
No, brilliant. Thank you.
But I would say that what grants do is they help give the founders that runway. So although it's not co-investing with another VC or institution, it might allow them to have that longer runway. And as David mentioned, that magic 18-month runway, if grant funding can help play a role in extending that, then it will ultimately encourage more investors to step in and invest.
Yeah. No, thank you. Brilliant. Thank you, Jack. Thank you, David. David, if anybody wants to get a hold of you, what's the best way to contact you at River Capital?
Yeah, you can go onto the website. You can find my email address, my favorite album, as well as my telephone number. But it's david.walters@rivercapitaluk.com.
Right, brilliant. Thank you very much for that. I'm sure we'll get a lot of interest off the back of this. So thank you both very much for lifting the lid on what co-investing actually looks like behind the scenes and why it matters for founders, for investors, and for our ecosystem. And it only leaves me to say, if you're building or backing startups and want to get involved in more collaborative rounds, especially in, as we've discussed, the SEIS and EIS space, get in touch. We are at EHE.ai. And don't forget to follow or subscribe wherever you're listening or watching this. And we'll see you next time. Thanks, guys. Thanks very much.
Thank you.
Thank you for listening to this episode of Fast Growth the Venture Studio Way. If you found this valuable, don't forget to like, subscribe, and share it with your network. Want to learn more about EHE Venture Studio and about how we provide tech, funding, and advisory to ambitious startups? Visit www.ehe.ai. Thank you once again, and we'll see you next time on Fast Growth, the Venture Studio way.
Thank you.